Okay, hello investors. This is Don Vandenbord, Portfolio Manager with Revere Asset Management, and welcome to the latest in our Lunch and Learn webinar series entitled The Bear is Here, What's Next? Today I'm going to review what we've done, how we exited the most recent bear market, and our approach to re-entering. Let me bring up the full agenda here. So I'm going to talk about previous bear markets. 2 months ago, I did a deep dive into the last 11 bear markets and what to look at from a statistical standpoint. I'm going to go over that a little bit. I'm going to go over our approach as well as dispelling some myths about trend following and when you should be in or out of the market. I'm going to talk about sequence of returns. This is something we've been talking a lot about over the last year, and it's how when you get a series of really deep drawdowns as you're approaching retirement, those are the most devastating hits to your portfolio because that's the nest egg you're going to start drawing on as you go into your retirement period. Going to talk about the prior 5 months in the market, the rally, the top, warnings, and how we escalated lower. I'll go through a timeline and point out on charts some events that happened and also our reactions to it. And then we'll talk about what's next. I've got some questions about how to hedge, for example, how you hedge if you have a large taxable gain, maybe in an employer stock or something like that, or something you've held for a long time. How can you hedge that to keep that gain from disappearing? We'll talk about the concept of a follow-through day that we use for re-entering the market, as well as some other re-entry criteria as far as looking for what I like to call titans. These are the big captains of industry in the US and throughout the world, and re-entering them off the 200-day moving average, or as they come back up through the 200-day moving average, is a nice low-risk entry after a strong sell-off. We'll also look at some relative strength leaders and an example of earnings gaps. Those are really the things that we'll be looking for in-house to get back in if we see signs of a market bottom. Reminder, our website, revereasset.com, you're probably familiar with that because you had to go there to sign up for this event. We also have a YouTube archive of these Lunch and Learn webinars. So go to YouTube, just type Revere Asset. They'll all be out there. This one will be added later today. And of course, a reminder, this is for educational purposes only. We're not insisting that you buy or sell any stock. We're just presenting a sound, rational approach to participating in market uptrends and getting out of the way when the market is in a downtrend. And as always, we want you to remember, it's not how much you make in the market, it's about how much you keep. And there's no better time than the present to discuss that. And then at the end, I'll take Q&As and charts on request. So getting started here, background. Let's take a look, first of all, at two myths I want to dispel that you hear from the Wall Street Illuminati. What if you missed the 10 best days in the market? Most recently, I was watching CNBC, which I don't watch often, but I want to see how people are reacting when they do have some crises going on. And they had an equity strategist on from Bank of America, and she went with the tired old buy and hold. What if you missed the 10 best days? No mention. What if you missed the 10 worst days? And I'm going to show some stats in a little bit about how the best and the worst days in the most case happen when you're below the 200-day moving average. And then another myth is, I'm not really concerned. My portfolio is diversified. I own domestic stocks, international stocks, bonds, emerging markets. I want to dispel that myth of diversification and how that'll keep you from getting beat up. But first I want to touch on some conclusions and some analysis that I did on a study of the last 11 bear markets, and we've now got a 12th bear market to add to that. And the conclusion from it was that the market does not get into serious trouble until the S&P 500 breaks its 200-day or its 40-week moving average. So pouring over the stats with a simple exit, if you close at the end of the week 1% below the 200-day moving average. And then, of course, the question is, Wall Street always says, well, if you sell, you got to know when to get back in too. Well, how about if we re-enter if we get a close 1% above the 200-day moving average? So a study from the last 11 bear markets since 1968 showed that the average of those is a negative 33.3%. We're right now at negative 30% off of the high. The high of the market till you reached this sell rule where you have the 1% below close is 11.2%. In the case of this one, it was approximately 13% because we had been on such a strong run and we were that far extended above the 200-day moving average or the 40-week moving average. So until that sell rule got triggered, losing 14% is a whole lot better than double that, which is the average bear market drawdown. And by the way, which I just said we've reached already. And then if you do exit on close 1% below, the average sell, it'll save you 23% of additional pain. That means the market goes down on average 22.7% below where you exited. Well, if we exited at 14 and we're down 30%, we've already seen 16% of that 22.7%. So this bear market is playing out just the way the historical stats did. And then where do you get back in? Well, if you use this re-entry rule about buying a weekly close, if we get 1% back above the 200-day moving average, on average during these, you're going to be getting back in 9.4% below where you sold. Now, if this thing comes to a conclusion very quickly, you may be getting back in approximately where you sold based on what's going on in China and Japan and some other areas that have been hit with this. They seem to be going through about a 4-month starting to shut down to starting to get things back together, 3 to 4 month period. We don't know what the U.S. is going to look like after that, as far as how is the behavior of people going to change? How shell shocked will they be to participate back in the market? But when we get to the number 3 agenda item, as far as what's next, we'll talk about our reentry point. And by the way, we won't be waiting until we're 1% above the 200-day moving average to get back in. We have multiple other shorter term points where we can get back in. And back to this, what if you missed the test, the best 10 days? Look at this stat. Since 1960, 22 of the worst 25 days and 83 of 100 in the S&P 500 occurred under the 200-day moving average. That's why we discuss over and over again that is really your dividing line between a healthy market and an unhealthy market. And if you've seen some of the numbers on what we've had for down days as well as up days, but let's not separate the two. But the fact that they're happening below the 200-day moving average means you can't separate the two. You can't say, well, you're going to miss the 10 best, but you're going to miss the 10 worst at the same time. And then this stat, the overall average monthly return of the S&P 500 is plus 0.88%, but when you're under the 200-day moving average, the average return is minus 2.6%. Folks, all we're doing is looking at the historical numbers, applying them to today's market. This is how we exited in Q4 2018, and this is how we got out over the past 3 weeks. And we're going to walk through that shortly. So our approach, we work off of 3 time frames. Let me bring in here a timeline of what really happened with this coronavirus. And I'm going to bring this up on a chart so we can go through it day by day. So here's a chart of the S&P 500. This is a monthly chart. I want you to notice this goes back from 1995 and it trends to where we are today. What we're really looking to do with this get out below the 200-day moving average is avoid these huge drawdowns like we saw here when the tech bubble burst and 9/11 happened, and what we saw here when the financial crisis happened. This is a very compact situation as of right now, with this being down 30% off the highs, but it falls into the historical norm of what's going on with these big drawdowns. Right now, the action that we're seeing kicked in a lot sooner than it did during the 2007 to 2009. This last week and the week prior most closely resemble October of 2008. But I need to point out to you that we didn't bottom until March of the following year. So that was, 5-6 months later before the ultimate bottom was found. Don't know if that's what's going to happen this time, but we're going to pay attention to the price and volume action and see what goes on in the markets. And then we'll discuss how we react accordingly. And then, of course, if you follow us on the website, revereasset.com, every night Tim and I do a video. We do a podcast on weekends. That's your best bet for sticking with us and understanding what's going on in the market. We don't call it a market report. We call it market insight because we dive below what's going on, dive below the surface, and guide you as far as what's a normal market and what's not a normal market. So let me step back here. This is a chart of the S&P 500. This is a daily chart. So each one of these bars represents the high and the low and the close of each day. You can see right here, let's look over here on the news portion of this. We started this most recent rally on 10/11/2019. This was during the back and forth with China on trade, and it's this spot right here, 10/11/2019. We were going through this correction. We got some good news on the trade front. We gapped back above the green line. The green line is the 21-day exponential moving average. We always talk about the 3 time frames that we invest on here. Short term being the 21-day exponential moving average. This is when the market is most healthy, when you're trending above it. Then you've got the 50-day moving average. That's the red line. That's an intermediate term line. And then the black line, the key, the divider between a healthy and an unhealthy market is the black line. That's the 200-day moving average. So we were going through a mild correction here. We gapped above. On 10/15, if you watch my videos, understand the trend gauge. These are the changes to the trend gauge that happened in real time. On 10/15, I took it from a -1, which means on a short term, we were below the 21-day moving average, and it went to a +1, which means we got 2 closes above the 21-day exponential moving average. So this gives us a short-term buy signal, and we start getting active in the market. And the market stayed healthy. On 11/1, we got to the point to where we went from a +1 to a +2. This means that all 5 of the indexes, that's the S&P 500, the NASDAQ 100 or the QQQ, the Dow Jones Industrial Average, the S&P Mid Cap 400, and the Russell 2000 Small Cap. This means that they were all trending above their 21, their 50, and their 200-day moving average, and the market was going higher. And that's the ultimate signal of a bull market. You should be participating to as much as you feel comfortable at that point. So we got to there on 11/1. We bounced back and forth between a +2 and a +1 a couple times. You can see we dipped back below the 21 here, dipped back below it here, but for the most part, we were in a bullish mode going all the way up to where we peaked on 219. So 219 right here, you can see I have my crosshairs. This is where the market peaked. That was a 4-month rally. And at the time, I was talking about how the NASDAQ 100, which had been leading, let me bring up the NASDAQ 100, that's the QQQ. This was historically really stretched above its 50-day moving average. You can see here it closed on 219, 8.2%. I was paying a lot of attention to that. On 221, something started to change in the market. Tim's talked about this in videos, and we go back, and it's documented in our videos if you go back and listen to them. 221 was the second day of a big rotation out of growth stocks and into value stocks. You can see the drops here were kind of severe on the NASDAQ 100, still held above the 21-day moving average. Let's go back to the S&P 500. Sitting right above the 21-day exponential moving average, but it was the second day of growth. We started reducing exposure, and in the Grotection portfolio that I manage, which is the most aggressive and most active one, exposure was reduced over these 2 days by about 30%. Now, almost like the market knew, on 224, this is this day here, we opened up, gapping down 3%. This is the first time the coronavirus really started making headlines in the United States. We gapped down 3%, and the indexes broke their 21 and their 50-day moving average. You can see right here, and we started selling more. On 225, with all of the indexes now below their 50 and their 21-day exponential moving average, the trend gauge went from a +2 to a 0, both on the short term and the intermediate term. We had a negative reversal. We closed at the lows. We're now 8% off the highs. So this is the first time we're about in 50% cash now. It's 225 right here. This is how we got out. 226, we had another bad day. Let's point it out right here. We had a minor gap up, but we closed below the prior low, and the trend gauge at that point went to most bearish at a -2. On 227, this was the first break of the 200-day moving average and a close below it on the S&P 500. So we've got our first close below the 200-day moving average. At this point, the NASDAQ 100 is still above it. All the other indexes, the Dow, the small cap and the mid cap, were below the 200-day moving average at this point. So now 228, the next day we got a big gap down. Find 228 on here. What we did is we bounced off the 200-day moving average for the leading index. And why is it the leading index? Down here, the blue line is relative strength. That shows what index, what it's doing versus the S&P 500. Let's go back to the S&P 500. You can see we broke below the 200-day moving average and close below it here on 227 and 228. Gap down. We got a strong close into the weekend, and the NASDAQ 100 bounced off the 200-day moving average. So, maybe we're going to be okay. Maybe we're in good shape. So 3-3, this was a Tuesday. The Fed did an emergency rate cut. And we bounced very strongly, got back above the 200-day moving average, but by the end of the day, we had a huge negative reversal. The NASDAQ 100 reversed at the 50-day resistance. The S&P 500 reversed also, and that was another signal to us to, hey, if the Fed can't goose the markets, maybe there's more bad news coming. Things could get worse. Let's step through to the next inflection point. 3-6. We had a weekly close. This is the first time the S&P 500 closed the week below the 200-day moving average. Here we are, 3-6. So we tried to get back above it. We failed. That's a key point. We were strong into the weekend, so that maybe some short covering into the weekend gave people some hope for optimism. But at this point, we're 12% off the high. Terrible news hit over that weekend. Russia and Saudi Arabia couldn't agree on oil production limits, and Saudi Arabia did a huge price cut. And this was the first time on 3/9 that the futures opened limit down. Limit down means overnight. There are some rules on the exchanges. The futures can't go more than 5% below their prior close. So this was really a day, and this is really when the floodgates opened. But notice what happened prior to this. We had a weekly close more than 1% below the 200-day moving average. In fact, we actually had another weekly close back here. So this tells us to get on alert. At this point, we're at least 50% in cash. We bought a little bit back in here, but when we broke below it, we started selling some more things off. Again, this key line, and I can't stress it above, the market doesn't get into big trouble unless you're below the 200-day moving average. If you write yourself here and come back above, there's nothing that says you can't buy back in and participate in the market. In fact, that's exactly what we did in Q4 of 2018. But in this case, things continued to get worse and worse. The oil war started, so now we're 20% off of the highs with this brutal day. But the market is sadistic. It tries to suck you back in. We had futures limit up just the next day. You can't go, we were 5% below the prior day, 312. Well, let me step back a day. We had a second week day. Now the S&P 500 was down 9.5% on the day and 27% off its highs. So where are we here? We're on we're on 312, which is right here. Terrible day, but what the next day? We reversed up. Going into the weekend, Trump had a big presser with some big optimism. The market rallied shortly, again trying to suck some people back in. We took a couple small positions and got stopped out on them immediately the following day as the Fed announced another rate cut over the weekend and also some quantitative easing, meaning they're going to start intervening in the markets. But the futures open limit down, and this was the worst day of the entire down 9.1%. Actually, this day here that I have highlighted, down 12% on the day. We had a bounce yesterday. We opened limit down this morning, and you can see where we are right here. We've held the prior lows, but we're still in the low range. We're still about 30% off of the highs, and this is where we stand right now. So this is the explanation of how we got out. Let me take a look. Well, first, two things. Let me step back to this same time period in 2019, so 1 year ago, and I want you to look at the similarities between that sell-off and this sell-off. And it all starts with a break of the 21-day exponential moving average, break of the 50-day moving average, break of the 200-day moving average. And when you get that weekly 1% below close, you get it, you exit, you start wrapping up your positions. We're selling when this is happening. Again, we're fully allocated when we're above all three moving averages. We start taking some things off, locking in profits, cutting losses. The market's a tremendous feedback mechanism. Your new buys will start showing losses instead of gains, and that's the feedback that you need to stay the heck out of the way. And then we played badminton back and forth. There were a couple of false starts. There were two follow-through days in here that failed, where we started taking some exposure. But as long as we cut our losses quickly, there's minimal damage. And then the big swoon here that ended 12/24, Christmas Eve. And then the day after Christmas, we started the rally back, had a follow-through day, and we were off to the races. And that's what kicked off a very strong rally since then. So really applying the same rules that we applied in Q4 of 2018, we were applying in the same case. The only difference is we went so much lower now that we didn't in 2018. But you can tell by those stats that I showed of the prior 11 and now 12 bear markets. Those are the stats that you want to pay attention to. You can always get back in if you sell. If you have taxable gains, you can hedge. I'll talk about that in a little bit. Now let me take a look at some of the exits that we made and where they existed before. And the first one I want to bring to your attention is Boeing. We had a client transfer in with some Boeing. We also held Boeing in a blue chip portfolio. He transferred in with some Boeing, had a nice cost basis. We decided to get out of it by 12/18 at this point. Once it failed to get back above the 200-day moving average, it was in an IRA. They had a nice cost basis. We were giving it every opportunity. Finally, in December, we pulled the plug, and look where it is now at $100 today, 75% below the sell. This just echoes. You cannot get married to a stock because people think Boeing, it's a national icon. Sure it is. But this chart pattern here, when you start trying to get back above the 200-day moving average and you fail, start trying to get back above and you fail, this is telling you something. You just stay away from holding things that are in the 200-day moving that are below the 200-day moving average. Finally, the 200-day rolls over and we're 75% off the highs. Let's take a look at some other things that we locked in nice gains on. Tesla, we rode the first buy was down in here. We took full advantage of this, started making some sales. Finally, we exited on 2/4, 161% gain from our initial shares. It's now down more than, well, it's down another 10% today, so it's now down 60% off of there. That's how far it was above its 200-day moving average, and ironically, this is coming into a reasonable safe buy point if the market would right itself, but I'll talk about that a little bit later. Let's take a look at one more. Beyond Meat, we exited on 225. $225 at 108. It's now trading at 55.32. So it's now 50% below where we exited at. These examples just tell you over and over again how you can't fall in love with the stock. You have to pay attention to the technicals. We buy on technicals and fundamentals, but we sell on technicals. When the chart starts to deteriorate, you got to get the heck out of the way. So let's move on now to the next part of the agenda. So our approach to the markets, I talked about that. 3 time frames, buy the leaders, sequence of returns. This is a concept where the market on average returns about 7 to 8% every year, but you don't get 7 and 8% every year. If you did, the markets would be fantastic. Everybody would be in them. Everybody would be fat and happy. But it's these negative 30% days as you approach retire, these negative 30% years, which could go lower as you approach retirement. These are the things that can really crush the plans of people that you've been saving your whole life. And we can't stress enough how important it is to follow the sequence of returns. So now I just went through item number 2. We talked about the rally, the top, the warnings, and the escalation lower. So let's move now into what's next. Let me slide this over here. So let's talk about hedging examples. I brought this up, and these are actual examples that we're using right now for clients that have large taxable gains on accounts that were transferred in. And the first one that I want to talk about is a utility, NEE. We recently owned this also in our blue chip income portfolio and got stopped out on it. So you can see how NEE, let's go to a weekly chart. You can see what a fantastic winner this has been riding this up. So we've got huge gains. We don't want to lose them. We also don't want to sell and trigger a large taxable event if we can help it. So what can we do? We can buy something that is going to go up if NEE continues to go down. And in this situation, it's a utility. So we shorted the utility index, the XLU. So this means that every time the XLU goes down, the value of our short goes up. So effectively, we're flat on NEE. This means if it continues to go lower, our hedge will go higher and the value of your portfolio stays the same. Let's talk about another one, McDonald's. In a situation where can you find a sector ETF to hedge? You know, maybe, but I ran some comparison charts. Let's bring this up. Here's McDonald's. Now I want to ask myself, what's another big restaurant in the US and let's see if it acts the way McDonald's does. Let's bring up Yum Brands. You can see from the comparison chart here that they do act similarly the same. So what we did is put on a short position in Yum. So if it continues to go down, it's offsetting the losses of McDonald's continuing to go down. So if you can find an index ETF, a sector ETF, or a stock that acts very similarly to the stock that you're talking about, put on a short that's the same size or maybe a little bit smaller if you just want to hedge partial holdings of it. And if the stocks continue to trend the same, you'll be offsetting the gains and offsetting the losses. One more example, TJX. This really got taken apart recently. And let's do a comparison chart. I looked at a couple of examples, and Ross Stores, R-O-S-T, acts very similar to it. So put a short on Ross to offset the long on TJX. And so we hold on to them, don't have to trigger the taxable gain, and you get your portfolio the equivalent of flat. Another thing you can do is buy inverse ETFs in indexes. For example, this is a short in the S&P 500 SH. If you're in a retirement account, this is the way you have to go because you can't short individual positions in retirement accounts, but you can buy something at the SH that is going to go higher as stocks continue to go lower. But really, if you're in a retirement account, your best bet is to just sell the position out. You can always buy it back, and there are no tax consequences if you're in a Roth IRA or in a traditional IRA. So those are some examples of hedging. Now let's take a look at some examples of a follow-through day. Let's go back to the S&P 500 chart, and let's go back to 2019, same time as 2019. And what we're going to look at is the follow-through day that occurred on January 4th right here. So what is a follow-through day? Basically, we're looking for the market to form a bottom, and then 4 to 7 days after it forms a bottom, there is a situation where money will flow in very strongly to stocks. They'll break above resistance levels, and the market will be up, and you'll see leading stocks acting well. Here's January 4th right here. You can go back through our videos. Tim and I described how we started getting back into the market on this day. So we're going to keep a leaders list. This list is going to include leading stocks that are showing relative strength, titans of industry in the U.S., and some other stories that we may be interested in. But we've always got our leaders list, and I keep the 21 over the 21 list updated throughout these videos, so you've always got a fresh watch list, and that's where I do most of my buying from. So we started getting back into the market over here, and then we continued to ride this wave higher until the market ultimately topped in early February of 2020. So we were on a nice bull run the entire year that we participated very nicely in. Couple of pullbacks to the 200-day exponential moving average during this bull run, and we did sell some stuff throughout these periods. But notice we didn't close or break significantly below the 200-day moving average. So for that example, we would have only sold about half of our holdings as we broke below the 21 and the 50. But as long as we're holding the 200-day moving average, we're going to stay partially invested. So reentry criteria, let's look at a couple of things. First of all, some things that are on our watch list now that have been acting very well during this period. And there are things that really fit into what stocks are going to benefit by the coronavirus. Zoom is one that a lot of companies have sent their employees home. A lot of colleges too are having online learning. And what they're doing, Zoom is just a video interface where you participate in video conferencing. It's very popular and it's holding up very well. So this is definitely on our leaders list. Another one is Teladoc. This is basically you're doing a doctor's visit online instead of actually going into the doctor's office. Big trend in this. This trend started a couple years ago on this, where this initially broke out. You can see the problem is with the market, even though this is a leading stock, it's been very volatile. You can see it got up as high as 150 here and then dropped as low as 100. Stocks are volatile during this period. That's why we really avoid holding them unless we have very tight stops and very reasonable exit criteria. Let's see what else is leading. Gilead has one of the leading treatments right now, an existing drug to when people make it to ICU. It's an antiviral that has been working very well. That one's holding up very well. And I know everybody's seen the lines at Costco and Walmart for products. Costco struggled a little bit, but for the most part, look at the relative strength line on stocks like this. This says, how is this stock comparing to the S&P 500? And if you're going sideways, even if you're not making any progress, your relative strength line is going to continue to go higher. Same situation with Walmart. In fact, making new highs today, relative strength through the roof. People are buying their supplies now. Just because these are holding up during this period doesn't mean that these are going to be the leader of the next bull cycle. It may be that all of this is front loaded, and obviously if you load up with 3 months of supplies at Costco, there's going to be 3 months in there that you don't need to shop at Costco. So Costco's sales are probably going to drop off when this thing resolves itself. So as always, we're not just sticking with a story, we're sticking with price and volume action. Another one, let's talk about earnings gaps up. This is one of my favorite ways to buy emerging leaders. Koopa Software, yesterday it's been beaten down, but it had a very positive reaction to an earnings report here. It was up 25% yesterday. I wanted to get back above the 200-day moving average for possibly an entry point. This just says that at the moment, when they reported earnings, their stock was very well received. They weren't impacted, but it could be that their next earnings report shows that corporations are probably going to stop spending because of the slowdown all throughout the economy. Another one that gapped up very nice. Some Chinese stocks have actually recovered quicker than U.S. stocks. This is VIPs, a retail internet over in China. Very well received gap up on earnings. Obviously volatile because of what's going on in the market, but it's one that deserves to be on your watch list because it's on mine. And then the last example, Titans off the 200-day. This is a list that I keep of about 40 or 50 stocks of the captains of industry, and I want to see if I can get them cheap. So let's look at things like Vertex. This is a pharmaceutical. biotech that has the leading cystic fibrosis medication. You can see any stock that has not broken the 200-day is a very clear leader. Look at the relative strength continuing to trend higher on this. So Vertex looks great. Another one that's benefited if people are going to be home, they want to be watching Netflix. Netflix playing back and forth around its 200-day moving average, but again, look at the relative strength line. AMD, leading semiconductor, still hasn't broken the 200-day moving average. Very strong relative strength trending. This relative strength has been trending higher since it broke out here in October of last year with that most recent rally, and you can see it went from 36 all the way up to 60. So a very nice gain there. We participated in some of that. NVIDIA is another one showing relative strength from a standpoint that it's hanging above its 200-day moving average. Relative strength lately hasn't been that great to it. Again, maybe people are concerned about a slowdown, but again, Titan of industry is the types of things that I want to get into, and you can't consider something that's a type of Titan of industry without talking about Apple hanging out around its 200-day moving average, relative strength continuing to trend higher over the last 3 weeks. Amazon's another capital of industry hanging around its 200-day moving average, relative strength increasing higher lately, and finally Microsoft hanging around its 200-day moving average. One thing that the other myth that I didn't want to dispel, I want to talk about, I'm diversified, I don't have to worry about it, I own stocks and bonds. When you get into a liquidity situation like we're in now, hedge funds, pension funds, they have to sell whatever they own. So the baby goes out with the bathwater in a lot of situations. You're familiar with what the chart looks like on the S&P 500. Well, I own bonds. Bonds are going to offset that, right? Let's take a chart at BND. They worked for a while, but then they had kind of a climax run here and then fell through the roof. We exited our bond positions this week. Well, what about emerging markets? Don't they work? Or foreign markets? International isn't always tied to the U.S., is it? We'll take a look at this chart, and that gives you your answer as far as being diversified between international stocks and domestic stocks. Well, what about emerging markets? They're a separate asset class. Yeah, emerging markets, same situation, if not even worse. You can see how they gave it up. Okay, but what about real estate? Real estate is, it's tangible, it holds up, they're not making any more land. Well, the real estate index just dropped from 42% to 30%. When it broke below the 200-day moving average here, we stopped out of it in our Robotection portfolio. The pie chart people are still in their real estate. Robotection is 8 asset classes that we stay in unless they break below their 200-day moving average. There's no reason to be participating in an asset class that is in a downtrend. Wait till it stops going down and then get back in. And then finally, the great diversifier gold worked for a little while, but when you throw the baby out with the bathwater, you can see gold topping near 160 here. It's down to 140. GLD, GLDM are the last things that we hold in our model portfolios here, and it's flirting now with the 200-day moving average. If it breaks decisively below it, we'll get rid of that too. Sorry about that. So let's see, what else do we have here? RS leaders, ER gaps, tighten off the 200-day. That's pretty much everything. So now let's get to the Q&A and the charts on request part of the presentation. So somebody asked me to take a look at a chart of FXY, and what does it mean? This is a chart of the yen. It's a currency that trades as an ETF. And it's pretty volatile. I don't know what it's saying. I don't really look closely at currencies. Let's take a look at the U.S. currency, the UUP. This is the U.S. dollar, and it had been trending higher. Really, the yen is often a people look at it as a safe trade to go into, but we don't really mess with currencies much here. The dollar going higher is not good for our market because it means our goods are more expensive overseas, but you can also see the volatility falling through to FXY also. Somebody asked about preferred stocks. We own these in a couple of our portfolios, and what happened when a liquidity crisis happens is everything gets sold. You can see PFF. Another one that we owned in-house was PGX, but as always, when they break the 200-day moving average, this was one of the last things to get sold, but we sold it up around here. And at some point, everything starts acting like the market when the liquidity crisis comes in. So let's go to, if you have other questions, start typing them into the list. Let me take a look at a couple of these. I was told that stocks like CMG and Love would be good to buy. Well, if you're a bottom fisher, good luck. We're not. We don't guess the bottoms. Love is Southwest Airlines. You can see what's been happening with the U.S. airlines. At some point, they'll become a buy when traffic starts coming in. As far as Chipotle, a leading restaurant stock, but all of the restaurant stocks, when you can't have groups of 10 or more people for the most part around the U.S., all of the stocks are going to start look like this, which is similar to the McDonald's chart, which is something that we had hedged with Yum. But yeah, Chipotle, this is a leading stock, got up to 940 all the way down to 500. We locked our profits in on this when it broke the 50-day moving average. Let's see. I own spec plays that Kramer talked about, like Tesla and SPCE. Okay, let's take a look at SPCE. Yeah, this was the next big thing there for a minute. This is what I call an Eiffel Tower pattern, and it just reinforces that you need to have a stop when stocks don't always go straight up. In this case, somebody bought 42.49. I hope they're not holding it 80% lower, down at 10. Are we supposed to be buying when other people are panicking? Well, maybe if you're Warren Buffett, but if you bought the whole way down, there are a bunch of portfolio. If you just look on TV, there are absolutely never sell people that they told you to buy at 3,200, 3,000. They told you to buy at 2,800. They told you to buy at 2,600. They're telling you to buy at 2,400. What do you buy with if you never sold in the first place is my question. That's just an asinine approach to it. What other aspect of your life do you not take appropriate action when things start to turn south? If you're driving a car and your service engine soon light comes on, you don't just hope that it's going to go off. You take your car in to have it looked like. You check the forecast before you go out for the day, and you take an umbrella if it's going to rain. Why should your investments be any different when they give off clear signals like I've just talked about in this webinar? There are times when the market is healthy, and there are times when the market is not healthy. And if you want to boil it down to its most simple equation, it's when you break below this 200-day moving average. And that was the dividing line for us. And as I mentioned, the only things that we own right now, except for some clients that have big taxable gains that we have hedged, the only things that we have is hold is gold. BA, I showed that. I was told BA was a great stock. XLU should be safe, right? Well, XLU, again, this is the baby goes out with the bathwater thing. These are holding up better, but you can still see utilities have dropped from 70 to 55. That's a 22% drop. Anybody have any other questions? Feel free to put them in here. EMTY short retail up 35%. Should I sell? I'm not giving a buy or sell recommendations here. I'm telling you to have a plan. I can't call the top. I can't call the bottom on this. I know this is a very thin stock. Only trades, or ETF only trades 20,000 shares a day. I know that volume has picked up on it. What you need to do is pick a level that you don't give it all back, because giving it all back would just be stupid. XP, please. Let's take a look at XP. This is a recent IPO that failed a base breakout, and this coincides with what's going on with the market. Once the market started getting into trouble, IPOs are going to get sold. This is at the lows. This is you can see it's below the 50 and the 21-day moving average. It's a do not touch as far as we're concerned. Bill O'Neill said not to adjust your 401k during corrections, bear markets. Do you agree? I don't agree. I just showed you why not to agree. I understand what he's getting at, that the market, if you dollar cost average in, and I mean, if you have 30 years to retirement, sure, continue to do that. I'm in my early 50s. I don't have time to do that, and I'm going to use the rules that I unearthed um, during my study over bear markets, and that's going to be to get the heck out of the way when the 200-day moving average is broken on a weekly basis. Good point about William O'Neill. He always had sell rules in individual stocks, and he absolutely did talk about dollar cost averaging into broad 401ks, even if you're in a downtrend. But I'm not going to play that game. Again, a lot of it depends on your age and risk tolerance. mRNA, somebody wants me to take a look at. This must be a biotech related to the coronavirus. Here's the thing. If you bought this when it took off above this 30, were you going to hold it when it dropped 33% within the next week? Yeah, it's higher now. We just stay out of the way for the most part, and don't really get involved in speculative biotechs. This one has traded for a while. It's got a nice relative strength at a 98. I'm guessing this, I don't know the story, I'm guessing it's tied to the coronavirus, but for the most part, we sell when we break. Let's see, REGN, yeah, I mentioned this is one of the leaders. They've got that coronavirus treatment if you get into ICU, and it's been holding up very well. The question is what happens to it if the coronavirus cases go away? Does it collapse, or does it continue to go higher? And again, that's why we have sell rules. When to get back in for buying seems like waiting till the 200-day moving average seems far. I agree with that. I talked about getting back in following this follow-through day concept, which happens 4 to 7 days off a low, just the same way we did in January, and in-house, that's going to be something we're looking for. I talked about a watch list, I talked about earnings gaps, and I talked about some relative strength leaders. We won't be waiting for the market to get back above the 200-day moving average to get back in. Do you manage money from Canada? I'm not sure about this. Email dan@revereasset.com. He can answer your question. That's Danny's the majority owner of the firm, and he will have an answer to that. Okay, this is a long one. Has there been a study about stock characteristics that perform the best out of a bear market? Out of a bear market, yeah, relative strength. Is it stocks that have the highest relative strengths? Well, that's what I'm looking at. Stocks that stay above their 50 and 200, absolutely, because they're going to be showing relative strength. So the stronger the stocks during the correction bear market, are they the best performant when the market goes to an uptrend? This is what I follow. This is what William O'Neill, Investors Business Daily, and MarketSmith follows. And if you played that game as far as looking at what held up well during Q4 2018, it was the software stocks that showed superior relative strength, and they were the stocks that led the rally for the first half of the year when the market had its follow-through day. Kramer blew up his hedge fund, which is why he left and now does media. Okay, I mean, Kramer recommends thousands of stocks, hundreds of stocks, and he doesn't always tell you exactly when to exit. Kramer's a pretty smart guy. I don't watch his show. Let's see, can you go over the high to sell minus 11% drawdown from your first slide? Yeah, basically what it means is, let's go to the S&P 500, and the study showed that, come on now, S&P 500, it showed that from the high to the first 1% below weekly close was an 11.2% drawdown. In this case here, the high, at that time, you were 11.5% above the 200-day moving average, as you can see there, at the bottom line of this box that pops up. So that was in line pretty much with where you broke below. In this case, I think it was about 13% before the 1% below got triggered. But the study of all of them, it says from the top to the 1% close below the 200 days on average, about 11.2% drawdown before you get that first sell signal. Let's see. I think that's about all the questions. My broker told me bonds were safe. Well, get a better broker because, as we mentioned, everything goes down when you get into a severe bear. Here's a good question. How is Revere doing compared to the market in this environment? The analogy that I'll use is while the market had a head-on collision, we suffered a fender bender. Our portfolios are down single digits, less than 10% for the most part. The robo portfolios are down about 11%. Compare that with a 60-40 portfolio is down about 18%. The S&P 500 is down 30%. So our exit rules have served us very well in during this, and I'd say the head-on collision versus the fender bender is a pretty good analogy. What about the rate of declines in indexes or individual stocks? Is that something to consider? Well, yeah, the rate of decline in a normal market is a very clear sell signal. The rate of decline, you never know what's going to happen in the rate of decline until you get, I mean, let's look at some of these sell-offs. This is a pretty decent sell-off from 29.64 to 27.28 over a course of about 5 weeks, but we held the 200-day moving average. So we would have been, as I said, lightening up as we break the 21 and the 50. Here's another pretty harsh sell-off, but these happen all the time when you're above the 200-day moving average. This one's from 30.28 to 28.22. This one's from 30.21 to 28.55. This is, pretty quick. But this one was very quick, very harsh, had a harsh snapback. You don't know what the rate of decline is going to be until it actually happens. As I said, this looks pretty harsh, but it bottomed during this week and a half period here, but we righted itself, went sideways, and broke back higher. The rate of decline is definitely something to pay attention to, and when it was this severe, that's why we raised cash so quickly. But again, we're following our rules relative to the 21-day and the 50-day moving average, and then the 200-day moving average. How easy is it to become a Revere client? Do you use? Yeah, we use, great question. We use Schwab and TD Ameritrade as our two custodians. Means we have no access to your funds, which is the way you want it. You always want your funds to be custodied at a third party, and it's ridiculously easy. You just contact Dan at revereasset.com. He'll take some information from you, and then we use DocuSign online to sign the paperwork and get the funds transferred over from wherever you're at. And we start applying the rules that have served us so well during these last two. I mean, these are two bear markets in 18 months now. I would expect a pretty tough sledding going forward. Can you take over my 401k? My work buddy was bragging about Janus funds. That is awesome. Let's take a look at some Janus funds. It's not the one I want because that's an income fund. But again, this is what happens to income funds when everything starts coming apart. I don't know the symbols. Let's see, here's a small cap growth. Janus is great in an uptrend. This is what happens to Janus funds in a downtrend. Nothing different than what goes on in the rest of the market. Can you comment on PHIYX? Let's take a look at that. PIMCO high yield, yeah, high yield, same situation. High yield bonds act the way the market acts, plain and simple. It's a lower beta, but for the most part, high yield mutual funds. Let's take a look at a high yield HYG as an ETF. There's also one called JNK, and they're going to come apart too, the same as the market does. If you apply the 200-day moving average rule to it, you sold here above 85 while it's down below 75 now. Downtown Josh Brown. Oh, yeah, it's not downtown Josh Brown. We call him drawdown Josh Brown because he's told people to never sell while they've now lost 30% of their money. He works for a Ritholtz Management, which is a pie chart buy and hold. They're going to never sell, so they can't tell you to buy the dip. Can't buy the dip if you never sell in the first place. And is it too late to sell the Starbucks that he told me to buy? This is funny. Starbucks, I can't make the decision for whether it's too late for you to buy or to sell Starbucks. I can tell you what our rules are for getting out of it. That's a very tough situation if you're still holding on right now. I would say hedge to stop the bleeding. If you're in a hole, stop digging. Let's see, does the downturn in PHIYX precede the downturn in SPX? Well, let's do this. Here's PHIYX, and let's do a chart comparison to the S&P 500 to see. First, let me type this correctly. PHIYX. The only time we own mutual funds in-house, for the most part, never. We have some people that have 401ks that we manage that only have mutual funds. So yeah, we'll manage those. That's the only time that we own mutual funds. We stick with ETFs and stocks. So let's compare this to the S&P 500. When did this turn down? So here's the first drop. It bounced, and it looks to me like it went down about the same. It started falling apart about the same time that the market was falling apart. You can see this really zigs and zags with the market, just it's got a lower beta. We don't own high yield. There's no reason to own high yield bonds. They act like the market with lower beta. It's like buying, they're going to go up less than the market goes up. They're going to fall less when the market goes down. You can see over the last year, the S&P is down 16%. This is down 5.4%, but it's going to fall apart the same way. Let's take a look at year to date on how we're doing. It's down 12%, while the S&P 500 is down 26%. The reason why we don't own these is because we're going to apply our rules to stocks that are going to kind of act the same way. This is like hedging 50% of your portfolio by buying this. It's just a lower beta, but it acts the same way that the stocks act. Don't dividends help me through bear markets? Great question, because we own a bunch of dividend ETFs as part of our blue chip income portfolio, and we've been stopped out on every one of them. Let's take a look at some of the leading dividend ETFs. That looks like the market. Great, you're getting a 3.5% dividend, you're down 25%. You tell me which one you want to do. Here's another one, VIG, and these are ones that I've owned and gotten stopped out on all of them. 130 down to 97. That's 25% plus. So you're going to lose a little bit less than the market, but same situation. That 200-day moving average is your key. 3 minutes before the top of the hour, I think we're going to wrap it up unless there are any more last-minute questions. The only outstanding question was, do you manage funds from Canada? And again, email dan@revereasset.com and he can adjust that to you. Since mutual funds have to always be invested in the market, where is the big money going? Seems like every sector is severely down. Mutual funds that have to stay invested are going to look for the lowest beta names. So, and this is why the XLP has been up the last couple of days, because when your prospectus for your mutual fund says you have to stay 95% invested, you're going to look for what's going to go down the least. As you can see here, the relative strength is going up on XLP, but here you're down, so 55 from 65, so 10 on 65, you're down about 16%. It's better than the market's doing. This is where people that have to stay invested hide their money, in things like Procter and Gamble, in things like Walmart, things that are staples, in things like Clorox, in things like Colgate. But again, you're not going to be totally insulated from the market, but you will lose less. Here's Clorox. I mean, that's a nice breakout, because who doesn't need bleach in this environment, right? What is a high quality stock in this environment? One that cash is the high quality stock in this environment. That's my answer to that. And with that, I'm going to wrap it up. I appreciate everybody taking part in this today. If you're live, you're going to get an archive of this. I would appreciate it if you pass it on to your friends and family. We have a lot of, our hearts go out to the people that didn't have a sell discipline. When I did that 2 months ago, I did the stay clear of the bear. hoping that people would get a plan. I know it's not reached everybody, but please share our work with any friends or family that you think might benefit and keep them out of trouble in the future. So that's going to wrap it. For 3/18/2020, this has been Don Vandenbord, telling it like it is. That's how I always wrap my my presentations. I either say that with just the facts, don't argue with price, or it's not about how much you make, it's about how much you keep, and that's certainly the case in this market. Thank you very much, everybody.